Happy Friday. Eric Bible with the Bible team at Neil Home Loans. An incredibly somber week, to say the least. The actions which unfolded last weekend in Israel at the hands of the terrorist organization Hamas were devastating and outright unacceptable. The individuals that suffered will never be forgotten, and to that, it should never be tolerated. With that, we stand in unison with our brothers and sisters in Israel, as well as the Jewish community, both domestically and globally, and know that we condemn the heinous attacks conducted on behalf of Hamas. Where, yes, it is incredibly challenging to transition in such a somber time, things must move forward. Just as we're seeing in Israel, they're marching forward, we must do so here. With that, those events have had implications in our domestic financial markets as well as the global financial markets, and we've seen mortgage interest rates respond accordingly. As we closed last week, we challenged multi-decade high with the 30-year fix, moving to 7.81%. As we started this week Tuesday, with Monday being a holiday, we saw a gradual decline, albeit not the levels that we would like to see, but a decline nonetheless. Whereas this morning market open, the 30-year fix is sitting right around 7.6%, which again is a welcome relief to our buyers and sellers. In addition to the global impact of last weekend's events, we had some important inflation data released this week, as well as a number of Fed presidents speak on what market direction looks like going forward. So first, Thursday, yesterday, we received the Consumer Price Index report, which reported inflation data on both the headline number and the core number. Headline number was slightly elevated, and we believe this is tied to the recent run in the cost of oil. Albeit it did not spike dramatically, there was an increase where we saw the headline number remain at the 3.7%, but the month-over-month number went with an expected 0.3% up to 0.4%. The core rate of inflation, on the other hand, which removes food and energy, did decline. We saw the year-over-year reading move down from 4.3% to 4.1%. Now, keep in mind, the core rate of inflation is the target or the talking point the Fed has referenced in numerous occasions. That 2% target, the core reading is that focus. Now, again, 4.1% is above the 2% target that they've imposed. So we are still elevated, but we are seeing gradual improvements. And that dovetails into a number of comments that voting members from the Fed have made over the last few weeks, more specifically this week, that it is expected at this point, future rate hikes are starting to come out of the equation. Now, obviously, the Fed is the ultimate sayer in what will happen next. But given the tone and the change of narrative from a number of voting members, it is likely we will not see additional rate hikes. And it comes down to the fact that they're referencing that the market is taking action with curbing spending, specifically in the lending world, based on the rate hikes. We've seen lending across all channels, not only in mortgage, but consumer spending, commercial lending, the list goes on, pull back due to the fact that rates are elevated. So it is likely that we can expect these rates to remain at this level for some time. And in turn, future rate hikes look to be off the table. Now, again, the question becomes, well, what happens next? And where do things go from here? It is still a day by day, just given the recent events that occurred in Israel, but it is appearing that the Fed is not going to raise higher rates going forward. And again, with the inflation data received this week, we're making forward progress. The next big question that continues to arise is affordability. No doubt with mortgage interest rates where they are, affordability, we're seeing it have implications across every market in housing in the United States. And I'm happy to report that there is now a program designed to attack affordability at the higher price point homes. We're all familiar with the temporary buy down, the ability to get interest rates of last year today. However, those programs were typically reserved for lower price point homes, specifically in conventional financing. We've just introduced a temporary 2-1 buy down for loan amounts up to $2 million. Huge game changer. I've included an example of a recent scenario we came across where the seller was entertaining potentially reducing their price by over $100,000, and the buyer was still a little timid to move forward given the fact that rates were in the sevens. But we introduced this concept of the 2-1 buy down that awarded the client the opportunity to have their first year payment based on a 5.6% rate, year 2 at 6.6, and then year 3 and on going to the permanent 7.6 rate, which ultimately saved the client thousands of dollars a month in monthly payment. If you'd like to know more, definitely reach out. This program right here, as well as the other buy down programs we have, is tackling affordability head on. With that, going forward, yes, it is a challenging time, to say the least, layering in global events, not to mention, domestic events as well. It feels challenging. With that, there is always opportunity, and that opportunity just needs to be sought out. If there's anything that we can help you with, we'd love the opportunity to support you. With that, make it a wonderful Friday. And again, remember to spread kindness.